Swasti. Indeed, impact measurement and management is the cornerstone of impact investing. Our IMM report, as Swasti mentioned, is available for download in the document library on the Prabhav platform. Welcome everyone. As we wrap up day 4 at Prabhav 20, this is Neha from IC team, and it is my pleasure to welcome you here. This discussion is on scaling pay for performance. We are here to discuss how paying for success encourages private investors to invest in impact enterprises by providing a unique approach of financing. We are joined by seven eminent speakers today. I will quickly take a minute to introduce the moderator and will be out of your way. This session is moderated by Aparna Duas, Senior Manager at Asha Impact. Aparna leads portfolio management for Asha Impact and manages the activities of the trust, focusing on policy engagements in affordable housing and urban development, energy access, as well as the work on blended finance instruments. Asha Impact, as you all know, was founded in 2014 by Vikram Gandhi and Pramod Bhasin as a network of like-minded business leaders and philanthropists to leverage their collective expertise, networks, and capital for social impact. Over to you, Aparna.
Thanks so much, Neha, and wonderful to be here on the panel with all the esteemed panelists that we have today. I know this is the last session of tonight, so we'll try and keep it as high energy as possible, and hope to get great audience participation as well. So without much ado, I think, let me start by setting the context for today. As Neha mentioned, we're here to talk about pay for performance instruments and how do we scale those. Let me just quickly bring up my screen and we'll get started. Great, so hopefully you can all see that. So as we all know, this number has been, broadly, it has been broadcasted quite widely that India obviously has a very daunting gap in the need for, SDG financing. So the gap is currently at 0.6 billion, and this is an annual estimate that we're looking at. With COVID, of course, this number would have only gone up. So really what we're trying to look at is, how do we catalyze more private sector capital to really support social enterprises and enterprising nonprofits and support them in the best possible manner, focus on outcomes so we're achieving the SDG outcomes together collectively as the government, as civil society, as well as investors. Now, India already has a very robust ecosystem of nearly 3 million nonprofits, as well as about 50,000 odd startups who are engaging in solving a lot of these complex problems. Only about 600 of these had received funding over the last decade or so, as we've seen in the latest report that we put out with IIC. And majority of them, nonprofits and for-profits, continue to be subscale. Now, while we've seen private philanthropy really scale up, and the government money also continues to flow in, we definitely need to up the ante quite a bit, get impact investors, commercial investors involved, and really participate in the development narrative as well. Blended finance as a tool, of course, can be used for this, and very simply put, it's bringing together commercial capital as well as development capital, really leveraging whatever philanthropic capital we have and deploying that to achieve social and environmental outcomes. Blended finance is a very broad term. It's not anything new. It's been around for ages, but the instruments that we're more familiar with these days are impact bonds, social success notes, default guarantees, all which have been used in India as well as globally. When we look at the global blended finance market, it's of course been growing steadily. As of 2018, we've seen about 140 billion mobilized in transactions. These are some of the instruments and facilities that I talked about just before this. While 140 billion may seem like a large number compared to what we've seen in the Indian impact investing industry, and it continues to grow. However, when we see the need for capital that's required for development outcomes, as well as what the capital that's sitting currently in global financial capital markets. This is just a drop in the ocean. So really, I think the call to action today is to see how do we make these instruments work for the beneficiaries, for the non-profits and for-profit enterprises, and for the investors, so that collectively we're really solving for these complex development challenges. When we look globally just at impact bonds, which is going to be the primary focus of our discussion today, and a couple of other pay for success instruments, roughly we've had anywhere between 400 to 500 million catalyzed. So 140 billion is the global blended finance market. Impact bonds, of course, are a small part of that, but definitely growing. When we look at India as well, we've seen the market really take off in India in the last couple of years. The first transaction here, of course, is, many of us in the audience, as well as the panelists will know, was the Educate Girls Bond, which was set up in 2015. Really looking to increase both student enrollment as well as learning outcomes. This was, of course, a small bond, sub 1 million. But since then, we've seen a lot more impact bonds come out in the market. Prachi will be talking about the Quality Education India DIB as well, which is roughly about a $10 million DIB that was structured. We've seen pooled funds coming up, with Kaizen. We heard about that in the education panel. Of course, IP Global, USAID also have set up a blended finance facility focused on healthcare as well. So we're starting to see a lot of these larger scale pooled fund structures as well to really realize the gains from economies of scale. And of course, when we talk about the ecosystem of players, this is of course illustrative, but I think the number of logos on the slide speaks for itself. That we do have a robust, market for outcome funders, risk investors, service providers, evaluators, intermediaries, all, each playing their own part in really helping scale up this market in India. So currently, when we look at it, we have 4 transactions. So the Educate Girls, of course, completed and showed stellar results. The Quality Education India DIB, has finished 2 years of implementation, and again, Prachi will be talking about that. It has really shown remarkable results in learning outcomes, making the case for pay for success instruments just that much stronger. We have Utkrisht, which is a bond in healthcare, which is currently underway in Rajasthan, and of course, recently, Social Finance India, along with the Central Square Foundation, also launched a bond in early childhood literacy in Haryana. So these are all, great examples of how pay for success instruments are being used. Outside of impact bonds, we also have social success notes. Again, the Dell Foundation has been championing that. UBS Optimus Foundation has tested that in Africa. Grameen and Acumen have also launched a series of social success notes in India, where the concept is similar, where you have 3 main parties. A service provider that is working relentlessly with the beneficiaries to achieve certain social outcomes, which are pre-decided at the start of the contract. You have a risk investor or an impact investor who provides them the upfront capital that they need to run this program. And if the service provider is able to achieve these predetermined outcomes, in that case, an outcome funder gives them their principal plus an interest payment back. Now, there are nuances to this. And impact, what I just described is typically what you see in an impact bond model. We've seen in a social success note, you incentivize for impact by actually offering interest subvention to social enterprises. Dan from UBS actually talked about impact carry, where you're also incentivizing for impact if you actually overachieve for the targets as well. So we're seeing a lot of nuances, but ultimately what really makes this instrument key to achieving outcomes is the absolute razor sharp focus on that, and really aligning all stakeholders on the key social objectives which have been set out for the intervention. So all this sounds great, but of course, we would love to see this scale up much faster. I'm not going to go into the details, but just to frame the discussion for today, there are 4 or 5 key challenges that we're seeing in the scale up. One, of course, is the limited outcome-focused capital that exists today. The participation from government, especially in India, hasn't been robust at the moment. However, interestingly, outside of India and globally, I think about 180 odd social impact bonds exist, but India and other developing markets have gone the development impact bond way, where it's a foundation or a multilateral agency that's really paying for outcomes. Second, doesn't require much of an explanation, is the standardization and outcome metrics. The sooner we can achieve that as an industry, we'll definitely be able to move the needle and get these to market much faster. The pipeline for investable opportunities also, we've heard people talk about a constraint on that front. And lastly, since the instrument is still fairly nascent for the Indian market, we'd say that there's a lot more that needs to be done in terms of awareness, contracting, templatization, to really reduce the timelines and the costs that are associated with these instruments. But I don't want to end the context setting on a bad note. So I will, say that there have been positive regulatory tailwinds as well. With the recent CSR law amendment, which is still awaiting final notification, we'll see the participation of a lot more CSR capital as outcome funding as well. The proposed social stock exchange, is also talking about listing instruments such as such as impact bonds, social success notes, and other pay for performance instruments. And lastly, and I'm personally very excited about this, is the increasing government interest. Looking at these instruments as a way to really bring a lot more focus and achieve efficiency in achieving the set out outcomes. So with that, I'll probably pause right there, introduce our panel today. So we have with us, so Prachi, maybe I'll start with you first. Prachi is the director of the Michael and Susan Dell Foundation. We have Pradeep, who's the regional director of India, Nepal, and Sri Lanka for Ford Foundation. We have Eric, who's the director for Center for Innovation and Partnerships at USAID. We have Francois, who's an associate with the Palladium Impact Capital Group. The USAID innovation financing platform called PEHL, and also leads impact investments at IPE Global. We have Tushar, who's an associate partner with Dalberg. And, we have two special guests joining us today as well. We have Mr. Shravan Hardikar, who is the Municipal Commissioner of Pimpri Chinchwad. And we have Avneet, who leads international collaborations and corporate strategy at National Skill Development Corporation. So a very warm welcome to all of you. And, really looking forward to the discussion. So Prachi, if I can maybe, start with you, since Dell Foundation has been, leading the way in a lot of these instruments, especially in education and skilling. Would love to hear, about the different instruments that you've piloted and what have been some of the key insights that have, come out from there. And I'll bring up your presentation as well.
Thanks, Aparna, for setting up the session so well, and also for all the work that Asha Impact is doing to at least solve the fourth problem around knowledge that you pointed. Outstanding work, as well as the recent report that you've released. I think that does a great job in terms of building the knowledge in the sector. So, for the foundation, impact and outcomes has always been the central, the cornerstone of all our work. So for us, the pay for performance programs has almost become like an obsession within the foundation. And especially this year with some of the new launches that we've done of debt guarantees, the structuring of the jobs bond that we're doing with Avneet and team at NSDC, we've probably now created these instruments for all the sectors that we work in, which is education, financial inclusion, and jobs. And the list of 6 that you were showing, we have probably now piloted or scaled at least 4 or 5 of them, which is the development impact bond, the social success note with VARTHANA and ISFC, debt guarantee with Ford Foundation, and a lot of the jobs and skilling dip, which is the closest to SIP that I know of in India, which will also get launched sometime soon. So there has been a lot of frantic activity within our foundation to look for these kinds of programs. And the underlying theme has always been that can we make impact front and center of all our work, crowd in funding towards and scale higher impact programs and create more impact at scale through these programs with sustainability. So I can give an overview here, Aparna, if you move to the next slide, of the work that we have done in education in particular. These are the 3 examples of the several pay-for-performance models that we've looked at. First 2 are performance-linked incentives for school financing, social success notes. These were with the India School Financing Company in VARTHANA. These are interest subventions where in order to improve learning outcomes, what we had done was that if schools, we had given debt to ISFC and VARTHANA, and there was a quality improvement program layered on top of it, which means that if schools where on lending was happening, improve learning outcomes, then the interest rate goes down for the schools and we subsidize that. So that program I'll be sharing some also of, and we've all heard a lot about the education impact bond, where we are playing the role of an outcome funder that is for not-for-profits, and that too has been about scaling high-performing NGOs and organizations in India. So I will spend very quick couple of minutes on explaining it, but more time on the results, because the objective is that more of us get convinced that these as tools work and these as instruments are working, and collectively how can we scale it. So a complex diagram to just demonstrate the simple structure, which was in fact there, is that Dell Foundation extends debt to VARTHANA, which they are on lending to different schools. And we go and measure the learning outcomes in schools at 3 points in time: baseline, midline, and endline, and decide whether they are eligible to receive the awards. And if they in fact are eligible to receive the rewards, then the interest rate for the schools is reduced by VARTHANA. And so therefore, VARTHANA has a variable coupon rate for us on the debt that we have extended to them. The reason we actually went ahead and made several assessments along the way, we typically believe that school improvement takes at least 2 years, but we had done a similar program with ISFC, and we found that 2 years is a very large gap. You cannot just leave schools on their own or service providers on their own. So this was one learning which we integrated into this. As far as the outcome is concerned, we have kept it very simple. We found, this is what we've been doing across a portfolio for a really long time. Grades 3, 5, and 7, English and math, standardized testing, and look at the difference in endline minus baseline. Interestingly, the new NEP also talks about key stage exams and also talks about testing at the levels of 3, 5, and 8. So we are probably moving closer to that standardized metric, Aparna, that you spoke about. Results from this were very, very positive. We found that, Aparna, if you could move to the next slide, we found we did this in 2 cohorts of roughly 140 schools. In the first cohort, we found that almost 40%, 37% of the schools dropped off. And that was a lot of learning for us on why schools were dropping off, why were they not understanding the full impact of the program. That number had improved to 15%. Of the schools which participated in the program, there were 2 levels of rewards, and the 5 percentage point and 10 percentage point respectively. We found in both the cohorts, 3/4 of the schools were actually achieving it. And if we look at the quantum of growth, this is hard to understand without comparing it to something. So for the purpose of comparison, I'll say that, typically we find that 15%, 15 points on the scale is equivalent to 1 grade level improvement for kids. So we found that in the first cohort, we had roughly 1 grade level improvement, and in cohort 2, slightly more than that. So this was one very positive outcome for us. And now we are looking at more scaled methods of taking this impact to affordable private schools. either through pooled funds like Kaizenvest and such, but really seeing that, how can more schools get this benefit, because the pilot was really successful. Similar results from the development impact bond. It's a much larger bond. Approximately 300,000 primary school students are impacted. There are several service providers, which are on the right-hand side. Society for All-Round Development, Gyanchala, Kaivalya, Pratham. These are all well-known, well-established NGOs. We are playing the role of the outcome funder, and UBS is playing the role of the risk investor, which means that they are providing the upfront working capital to the NGOs if as per the assessment, very similar to the assessment that I just spoke about for VARTHANA. If as per that assessment outcomes improve, then VS funders have to pay the principal that UBS has given to these, plus an interest which goes back to UBS if the outcomes are achieved. Again, very, very positive results on this as well. We have found that they have overachieved on the targets. So if I were to just pick a few examples over here, Gyanchala, which is row number 5, heavily overachieving its target. So the target that we had set for them was around 35, and they have achieved close to 150. So 3x kind of achievement on the scaled score that we are finding. And this is very interesting for us because these targets were not set randomly. This was based on several years of data of us and other funders funding them and measuring what their outcomes were on the same scale. But being in this construct, and reputation now becomes a big risk for them, constant measurement and constant, I would say, pressure to perform is there. So this is another very interesting thing that we noticed, that not only are we achieving targets, but we are overachieving. So we are actually getting more bang for the buck in constructs like these. Year 2 results were very similar. This year, of course, because of COVID, schools are shut. So we will see what actual outcome we get at the end of it. Then these were in education. I won't talk a lot about what we are doing in livelihoods. Tushar and Avneet are here, and they will probably share some more insights on the design of the NSDC DIBS bond SIB that we are looking at, which is very similar in construct that we were already talking about. There is a set of service providers, which in this case are companies and organizations which provide skilling and job readiness. And we here are planning to play the role of risk investor and outcome funders will be playing as well. And the interesting part of us over here also has been multiple conversations that are happening on what is the right outcome to measure, what is the quantum of that outcome, and how will we ensure that that in fact is life transforming for the beneficiaries. So let me pause there, Aparna, and hear from the other speakers, and we can come back to some of the details on these.
Sure. Thanks for that, Prachi. I think it's really good to hear, the different instruments that you've been testing, and of course the evidence speaks for itself. So Eric, if I can maybe have you join in as well, since USAID was part of the first healthcare impact bond in India. What has, and you've obviously done as USAID other instruments globally as well. What have been some of the challenges, with Utkrishт? How do we really scale it up? What have been the bottlenecks? And are there learnings from your work outside that we can bring to India as well?
Yeah, listen, thank you, Aparna. I appreciate the introduction, and just wanted to say thank you for the invitation, and hats off to this esteemed panel. In terms of pay for performance mechanisms, USAID does have a lot of learnings. What we did learn is that it takes a hell of a long time to put up a DIB. We struggled. We tried to learn how to do it within the confines of USAID. As a bureaucracy, you can imagine what that sounds like, and the months and weeks and etc. I won't go on, but I could. Once we were able to actually issue that bond, we learned that it's a great tool that does align all of the actors, and that's a wonderful thing. As you know, early innovation takes time. It also takes money. That cost of development we've noticed in the market has come down, and we're very happy to see that pricing come down. Some of the learnings that we've gathered are there's a lot of learnings that we've gathered, but some of the things that we'd like to talk about today is how maybe we can open up such an esoteric, very finance-oriented instrument to mainstream. Make it plain vanilla. Take out the term interest rate, take out the term working capital, and use milestone-based grants. Pay for performance grants, and then you take away this jargon and you take away the unapproachability, if that's a word, that gap between a financier and development professionals like ourselves, or I think probably we fit into both of those categories today. But nonetheless, trying to break down those barriers and make it more mainstream. What I mean by that is, we have the working capital, right, in the development impact bond. Well, what if we just use grant there? Then we kind of take away that profit-oriented construct, in the sense that there should be some kind of payment for success. Well, if you take away that I or that interest rate, that could be where donors like ourselves can really play that role. Where that catalytic capital, we on that capital structure, we can absolutely put our money. And folks like ourselves are happy to see, hey, here's $10 of interest to carry $100 of development. Happy to see that. We'd love to see that 10 turn down to 6, maybe even less. But nonetheless, that's exactly the role that we'd like to play, even as that guarantor, whether there's not as much success as we anticipate. But by the way that the market has been acting, there's a lot of success happening. And even if some of the results are not hit in Q1 or Q2, soon, the way the instrument is designed, that implementing partner can react and maybe outperform some of the other barriers. Nonetheless, these are some of the observations that we have. Some of the other things that I wanted to share with this team is the need for, in terms of those costs coming down, looking at M&E costs, looking at tech-based approaches to reduce that. Design and structuring costs, as you guys know, that's a wonderful conversation with the financial advisor, with the outcome funders, with risk capital. If we could somehow mainstream that, if we could have terms that we could all look at, stare at, be very confident with, and that would be ideal. The one thing that I did want to end with is, Aparna, you mentioned this earlier, the social stock exchange. What a wonderful ecosystem where this marketplace can really blossom, having the buying and exchanging of development outcomes. And then finally, you mentioned this as well, and I'm riding your coattails, is opening up the door with the Companies Act. If we can get explicit language on the Companies Act that does allow for pay for success, then I think that opens up just a wonderful opportunity for India. And I can just imagine, that with the social stock exchange. India is already incredible, but what an exciting place that we could all be proud of, that we're all taking place in this ecosystem. I'm going to stop there, and thanks again for the opportunity.
Yeah, no, I think thanks for for bringing those points up, Eric. In fact, the next section we actually are going to be asking Palladium and Dalberg to talk about how do we templatize, bring down those costs. It is the elephant in the room which has to be addressed. So Tushar and Francois, I hope you're ready for that. But before I move on to them, I think the other important point which I actually didn't make during the context setting is when I was looking at blended finance transactions, especially in Asia and globally, India has, I think there's a convergence report out there on this as well, has seen one of the largest number of blended finance transactions. Now, all of them, maybe called differently. It's not a new concept. So we definitely are seeing a ton of activity in India. It's just about, like you said, mainstreaming that, bringing down the cost, templatizing that. So thanks for the points that you brought up. And I think some of the advocacy efforts as well that, Asha Impact has been doing with the likes of yourself and UNDP and others on this group today, hopefully, fingers crossed, will bear fruit soon. So Absolutely. So Tushar, if I can maybe come to you next and bring you in. I think Eric has laid the groundwork for this as well. But really, I think before we jump into templatization, we've heard about models in education and skilling and healthcare now from Prachi and Eric. Would love to get your thoughts on what are some of the success factors that you've seen in the impact bonds or other pay for performance structures that have worked well. And if you could talk about maybe one or two other sectors that you think these models lend themselves well to.
Sure. Thanks, Aparna. Thank you very much. Are you able to hear me well?
Yes.
Wonderful. Thank you. Thanks a lot for having me here, firstly. And just to give a quick background, I'm an associate partner at Dalberg, and Dalberg is a strategy consulting firm which has been working on a number of these instruments with a variety of stakeholders, some of whom are also in the room, to help them think through both the structuring, design, and also post-implementation, program management, etc. on these structures. Very glad to be here. We've been part of a number of the bonds which have been mentioned, and I'm glad to share some perspectives and learnings from that. I think coming to the question, I think it's a really interesting time for the sector. Pay for performance has seen a lot of investment in developed country contexts. However, as you rightly mentioned, Aparna, it has been, while there's been a lot of discussion, there has been relatively limited investment so far in developing country contexts. However, it was, in my mind, a phase of experimentation, especially as a number of these concepts were, were ported from different contexts, often developed country contexts, into developing countries, and the experimentation was basically helping with customizing these concepts so that they are more applicable to, for example, the Indian context. And the success that they've exhibited, especially in sectors like education, which has which is far and away the leader in the implementation, especially when you think about impact bonds, have now emboldened a lot of other sort of sectors and participants to try these out. The other sort of interesting trend that has happened is basically just the diversification of the kind of instruments that we are seeing, which goes beyond impact bonds are talked about the most, but you mentioned social success notes, and there are a number of other structures which have come up, which allow now for application to a variety of different contexts, and can be matched with a variety of different capital needs. Because of the confluence of some of these drivers, I think we are now beginning to see significant diversity in the kinds of players and coming from various sectors who are willing to try this out. However, while applicability is increasing, I think some of the fundamentals are still really important. And I think you mentioned, Aparna, what might be some of the key factors which drive success in this. One of the things that we always sort of recommend whenever we are working with any of our clients is that do not try to force fit a structure to anything. Don't start by saying that we want to do an impact bond and now let's figure out if it fits to our intervention. And that's really critical, especially because there is so much hype and there's so much conversation that there's and a lot of clients do want to be innovative. A lot of participants want to be innovative. However, important to figure out what the characteristics of the financing need are. And now, given the diversity of the pay for performance structures that exists, there is an opportunity to actually pick something that is right for that. And if it is felt that there isn't a need for something of that kind, then we would always recommend that think about what makes sense rather than trying to be innovative. Secondly, especially in this post-COVID world, one of the things which has become really important and is also part of a number of conversations that we are having right now is how do you price risk? I think that has become a fairly significant conversation. I think there was a lot of information available about how organizations are performing, how different operating models perform, what kind of outcomes have been achieved in a pre-COVID world. However, in a post-COVID world, it is becoming really challenging because paradigms have changed, especially in sectors where there is significant interest. So if you think about education, if education is moving from purely in-classroom education to remote or online education, then how do you price risk in that scenario? How do you know whether these changes actually help in achieving those outcomes. And I think that is something which needs significant thought and needs a little bit more engagement at this point of time. And that, I would say, is another sort of key element to think about. The skilling bond that was mentioned earlier and that we are a part of. This has been a fairly important conversation there to think about how do you price risk, how do you evaluate whether some of the precedents that you might have had from before the COVID times stay relevant or not, and important to think through that. And of course, cost. You mentioned that Aparna, one of the significant challenges I think with a number of these instruments is that they tend to be really expensive to set up. And if some of this thinking is evolving as we go forward, and especially in some of these sort of high risk environments, if there's a risk of failure, there's also this aversion to spending a lot of money before there's more certainty on how this could be implemented. So I think that has become a really important part of it. And I think what is happening more and more, which is helping potentially bring some of it is just the evolution of the sector. As I mentioned before, there's a lot of experimentation, a lot of different structures being designed. As the industry moves beyond that initial experimentation stage, there is a body of learning which has been created. However, I do believe that that body of learning it exists in silos. There are early attempts to actually break out of the silos, and Asha Impact has been part of a number of those attempts, including the recent reports that you published. And I think that is critical to actually reduce cost. I think there's a need to share information, to talk about standardized metrics. One of the things that really makes the commercial investing market tick is the availability of a lot of data, which allows for very, very quick evaluation of risk, very, very quick benchmarking vis-a-vis other similar transactions which may have been done in the past. And therefore, quite excited to see the initiatives in the sector. However, early stage, but I would hopefully these continue and we see cost coming down. And of course, there are a number of hygiene factors around clarity on what is being incentivized and why, what might be perverse incentives which are created, clear measurability, etc. Those exist, and those are more tactical and differ from transaction to transaction. Finally, just to also address, I think the second question that you had upon around what might be some of the sectors where we might be seeing traction. I do think that education, while there has been early momentum there is significant scope for further implementation there. So I mean, from a capital deployment perspective, at this point of time, the amount of capital which has gone in is still fairly limited, and therefore we might continue to see a focus there. However, a couple of sectors have come up quite strongly in conversations. Healthcare is clearly one, which has globally it has been one of the large sectors on which pay for performance models have focused, and we are seeing a lot of conversations around that. The other, as I mentioned before, is around livelihoods, where especially in the post-COVID scenario, the substantial focus, there is a focus on the employment bounce back, and again, going back to the impact bond that we are helping sort of design as well. There is, apart from that, there tend to be a number of conversations and a number of approaches where people are keen to evaluate if different models can be tested and then rolled out. There's also an opportunity, I think, in this post-COVID world to actually think transformatively about a number of these sectors. So finally, I think just one more point that I would like to touch on is that more exciting than the number of sectors and the kind of instruments which are being developed is just the diversity of capital which is now looking at it, ranging from governments to private sector to, of course, more innovative, not traditional exactly because it's a newer sector, but some capital which has already been part of it, like foundations, etc. So that's, I would say, in a nutshell, sort of our view around how this industry is shaping up.
Thanks for that, Tushar. I think great points, and especially the first one that you made about not trying to force fit a structure, but really trying to understand the business model underneath or the operating model underneath, and how can development finance be best be used for that. I think we're actually seeing that play out in the skilling space as well, right? So I mean, the bond that Prachi and you and NSTC are talking about, of course, is using the more if I can use traditional for impact bond way, but we're also seeing social finance that is for a different segment, but still within the same sector. Skilling is using low cost loans with backed by guarantees, also with NSTC. So you're absolutely right. I think we're seeing different structures being fit for different needs, and I think that's just a sign of how the market in India is also evolving. And like you said, different types of capital. But we'll bring Pradeep in on that in a little bit, and LM. But before we move to them, I think Francois would love to hear from you as well. The question really that Eric asked, right, to the panel: how do we, templatize? What are sort of the transferable learnings that can be applied from one structure to the other? Again, Palladium has been doing this in India and globally as well. Of course, we're also working in a transaction together right now, and Hardikar sir is also here. But how do you, really templatize, bring down those costs, and something that actually came from the audience in the pre-panel questionnaire that we'd circulated, and I think it's very relevant as well. There's so many stakeholders that are involved, right? So how do you really create a trust among the different stakeholders when you're executing such complex instruments?
Yeah, thank you. I feel like it's a tough question to answer, and I'm not sure if everybody on the panel will like my answer. I think templatization can work to an extent, but it's not the solution to it all. A lot of these solutions have to be, and instruments have to be very tailored to what you're trying to finance, right? And I had prepared kind of two examples in the water sector to exemplify that. So water is a very broad sector. It can touch on multiple things, and you can apply different instruments to touch on all those different things. So the DC Water Environmental Impact Bond that was structured by NatureVest, for example, is one that finances green infrastructure for conservation. But then you have the Social Success Note Impact Water one in Uganda that, and I'm going to quickly do a shameless plug for the report that Asha Impact has produced. I highly recommend you read the playbook that was developed as part of the ND SGP Learning Lab. It has kind of more detailed on that social success note in particular. But the point here is that within the same broad impact vertical or sector, you have one that's focused on conservation and one that's focused on a social impact, access to water for people to drink. And so standardization of impact metrics can only get you so far, all right? So that's one point. And then templatization is similar in the sense that I think some of these instruments are more geared towards that. Like Social Success Note, for example, you could create templates of term sheets that are kind of easily replicated since it's a more easily understood structure. I'm not sure to what degree some of the other impact bonds can reach that point unless they're kind of, again, in a very similar type of intervention. So what we're seeing with the pooled funds for Kai's Invest, for example, there it's very kind of similar and replicated. So that's where you can have some sort of templatization and reduce your transaction cost overall in order to bring scale and bring all of it together more, kind of bring more of it at the same time. And so just the same way, kind of, Tushar, I think you were making this point, the diversity of instruments, it gives you a lot of ammunition to serve a lot of different purposes, but it needs to be fit for purpose. So thinking back on those two examples that I gave, doing an impact bond would not have been as appropriate for the impact water example in Uganda because that was financing an enterprise that had a business model. So kind of finding the right instruments and then applying kind of that instrument to a specific solution and then trying to replicate that. That's what I think will accelerate the market. And then to kind of very shamelessly plagiarize Jennifer's Price kind of strategy from the keynote earlier today, I think once we've done that enough, we'll reach that demonstration that she was talking about. Then we can go to other investor, more commercial-oriented people that are more used to kind of the types of terms that Eric doesn't like, and educate them on how those fit within these structures, and then we can scale. So yeah, and the role of intermediaries in that, I think, is while in the short term might be costly, it is important to bridge that gap.
Great. No, I think great points, Francois. And I think, you know, what, without actually saying it, I know we've also discussed and debated this on the role of intermediaries. You know, so I think the question on how do you really build trust and, you know, get different stakeholders to align on the same mission, I think that's a very important one as well. So any thoughts on that, you know, given your experience on different transactions? How do you, I mean, you know, I think the negotiation on really, as, you know, Prachi mentioned as well in her comments, you know, how do you set the right outcome and the price for the outcome? Tushar was talking about that, right? That now with post-COVID, if we can refer to this era as that, you know, there is the whole risk of COVID. Will the models that we knew them yesterday, will they still work going forward? So how do you, you know, think about bringing the trust, bringing transparency into the ecosystem? So while I completely agree with you that templatization is only possible to a certain extent, how do we bring about more transparency, you know, which will perhaps then bring more players into the market as well?
I think, and this is not just for the pay for performance space, it's more broadly for blended finance. I think there's, you know, the public sector is accountable to ultimately taxpayer and its, you know, their stakeholders, right? And I think if the private sector wants to attract that capital to de-risk them and to, you know, improve their risk return profile, there has to be a little bit of a trade-off, and then the public sector should expect in return more transparency and being more, being allowed and able to publicize some of those terms. Because some of these issues, we want to create templates, but they're not public, right? And so, but you're providing them with an advantage, and so why not, you know, ask that as one part of the give and take? And to answer the other part of the question around intermediaries, I think part of that trust issues is it can be fixed with the intermediary, because that's ultimately what trust comes with understanding of one another. And at this time, there's difficulty communicating and speaking the same language, and that's really what the role of the intermediary is to try to facilitate that conversation without kind of sounding like I'm tuning my own horn, but
Well, thank you for sharing that. And you know, I think about when we're talking about expanding the market, I think definitely want to bring Pradeep and you know, LM into the conversation. Pradeep, so maybe let me start with you first. You know, like in impact investing, we've seen mostly that, you know, even the pay for performance structures in India have mostly been dominated by DFI, foreign capital. So how do you see, you know, different sources of capital, new sources of capital specific to India? How do you think we should, you know, catalyze them both on the risk and outcome funding side? Do you see a role for CSR over here, and maybe HNIs, impact funds? Like, how do you just see the market growing?
Thank you. First of all, greetings and namaste to everyone attending. And I know, given the time, for those of you who do follow IPL cricket, you know, you are obviously trading off between that and this is at least unscripted and more exciting than I think, I'd like to think, than IPL cricket. So thank you to everyone, you know, IIC and Asha Impact for putting this together. Aparna, I'd like to answer your question, perhaps, given that we have only a few minutes, to both look at the demand and supply side, if you may. And what I mean by the supply side here is the investors, like you said, both foreign and domestic, and the demand side, let's say, is the investees. So first, addressing the supply side, to your question about how do we get more domestic investors involved. See, I wouldn't necessarily say that the foreign or the international investors are dominating it. It's just that they've had more experience doing different kinds of investments in different places, and they're using their experience to kind of try out different models. Like Prachi and Eric said, there are very, very different models that are being tried out by international investors, and that's based on their experiences. I truly believe that the way to get domestic investors interested and involved in this is to focus on their strengths. Now, it is very clear whether it's based on regulations, whether it's based on your source of capital, whether it's based on how you're structured. There are strengths that domestic investors have, and there are strengths that foreign investors have, right? And I think we should focus on those rather than focus on the weaknesses that each of us may have. And in trying to create these structures, I think very clearly when you see that there are certain things that domestic investors can do, either because they're good at or because they're the only ones who can do it, I think that's how you kind of opt them into these solutions. And I think that's a smart way to do it. And again, there are enough examples in this panel where you have reached out to the domestic investors and brought them in because you know that's something that only they can do. And I think with the new regulations that have come out recently, it's very clear that domestic investors have a very, very big part to play just because those are things that only they can do. See, if I were trying to put these things together from the supply side, I would focus on what are the strengths that domestic investors have. And I think all of us know what that is. And I think I would really focus on that. And I would not try to get them involved in things that I know as a foreign investor I can do myself. Not necessarily because I can do it better, but I think it's just deciding what each of us can do good and just focus on that. Now, coming to the demand side, see, I think, and again, I'm being a little critical here of this whole instrument. I think if the demand side, I think the question to ask if you're an investor and if you're looking at the demand side is are we trying to use pay for performance to solve for a problem in sectors that already have access to funds and are trying to look out for new instruments, or are we trying to solve for problems in sectors that don't have access to any kind of funds? I think that's the question we need to ask ourselves. And often the critique that we have and that we hear from a demand side is that you're already going after sectors, and if I may just use an example, let's say that's education, that does have access to funding, and you're just trying to provide a new source of funding there, right? So the question to ask is, whereas if you look at certain sectors that don't have as much access to funding as, let's say, an education does, and just as an example, I'm using, gender equity or something like that, right? There the issues become more complicated. So I guess from a demand side, and this is where as investors, including as, we all need to ask ourselves, is an instrument like this trying to really solve the former, which is there's already funding there, but here's an innovative way of funding either because it's lower cost or better outcomes or more measurable or something, as opposed to a sector where there's very little funding and we're saying, here's an instrument that can actually solve a problem in a sector that has very little access to funding to start off with. And I think if we try to look at it from that perspective, we might actually, be able to define sectors more clearly into where they fall into one of these two, and maybe get the domestic investors more interested. Because now you have clearly defined that here are some sectors, either that falls into the first category or the second category, and here's an instrument that can solve. Because I do think this instrument has a role to play in both of these categories, but they have a very different role to play in both of these. And I think by defining that very, very clearly, being very, very transparent, you might see that it actually might convince more of the domestic investors, whether they're CSR, whether they're private foundations. I honestly don't really differentiate between the kinds of domestic investors. For me, they're all just domestic investors. I think they all have the same dilemma in trying to find out why it's not more transparent. Why is it that certain sectors attract more of these kind of solutions than the other? And I think that's a big service that we can actually do to this sector. And again, I think just to summarize, I think looking at it from a supply side, we need to play to the strengths of the different kinds of investors, and there are clearly strengths that domestic investors have versus foreign investors. And I think we need to recognize our strengths and go with it. There's nothing wrong in that. And I think from the from the demand side, we need to really, again, also be really honest to ourselves and look at various sectors and say there are certain sectors that get funding and there's a role that pay for performance has in that it brings a new source of funding. And then there are some sectors that don't get any funding at all, and that's a role again that pay for performance can play in that sector. I know we're short of time, to use.
Thank you for framing that, and I think definitely I would say at least there is interest in sectors such as WASH that Francois was talking about, that hasn't typically seen a lot of equity investment or investment even in the philanthropic space. So maybe those are sectors that are right, but of course would require the right kind of patient capital to first come and think about outcomes and critically seed some of these transactions before we see more interest coming in. Perhaps to your point on playing to strengths, that's where perhaps foreign foundations or people with more experience can come and pioneer some of these instruments in these sectors. But thanks for that, Pradeep. Ellen, quickly coming to you, just continuing this debate, and this is something that one is often trying to answer for the pay for performance and blended finance space overall. We've seen commercial capital participating in blended finance to some extent. Of course, there's co-investing happening in equity as well. Do you think commercial capital will ever participate in pay for performance structures? Is that an audience that we should go after? And there's a question coming in from the panel as well, I think, from the audience, which is what role can structures such as social stock exchange play in scaling these instruments as well, bringing in transparency and bringing in different pools of capital? So would love to hear your thoughts on that.
Yeah, well, thank you. Thanks, Parna, and thank you for having me on the panel. I think some very good points have been made, and I'd like to start where you sort of, put this whole thing in context. 50,000 startups in India, 3 million not-for-profits, and $500 billion gap to fund our developmental goals. Now, I think that's the context around which, I think we are looking at meeting this need for capital. I think if I really look at it from a different context, the fundamental issue we're solving for here is around, can you make systems which are less efficient, more efficient? You have a baseline, you try and improve it. So I think the fundamental argument is really, can I make something which is efficient, more efficient, and come out with better results? So the whole argument of having a pay for performance instrument and moving the needle from input to output based discussion, you are sort of creating a need for people to start working on efficiency on two levels. One is an operating level efficiency, and the other is a financial level efficiency. And I always see that at times we get so caught up in the structures and the notes and this, that, and the other, that we forget the core problem you're solving really is, how do I not only unlock new pools of capital, but how do I efficiently use that pool of capital? So with that argument, and where you sort of started this with 50,000 startups and the NGOs out there, I see that commercial capital clearly has a role. But before you put in the context for pay for performance instruments, the way, at least in our experience, we've seen, for example, in our PEHL USAID-led program, the USAID team has been working very closely with the government on solving the TB sort of problem. Big infectious disease, COVID has really brought many of these center states. So 3 million people who get it, 2 million are detected, and 1 million go missing, 500,000 die. So for us, the problem we were looking to solve is, look, how do we really, A, reduce the detection time, and B, how do we sort of improve the outcomes around that? So, we designed a structure. We felt that to cut down the time, we can actually, bring down the multi-drug resistant TB detection, improve it by 5 times, and also for TB. Now, to do that, the structure of the performance instrument we put had underlying two sort of, innovative companies or social enterprises, perhaps one of those 50,000 you mentioned, who were actually helping to, sort of bring in artificial intelligence or better detection and all that. So if you look at it from a context of a pay for performance, clearly in the whole structure, you have social entrepreneurs who are playing a role, who are for profit, and you also have a not-for-profit who's sort of implementing. So I see a role clearly that commercial capital goes, a long way, where they can give debt equity to those structures, those social entrepreneurs. From a not-for-profit, clearly, there would be a need to look at debt and borrowing. But clearly, if you borrow something, and Tushar made a good point that, how do you price the risk? How do you assess that risk? And I think the real people to assess that risk are people who are actually borrowing it. So in this case, a not-for-profit or an implementation agency. And a great example I like to make out here, when we sort of launched our other bond in the state of MP, that was around, again, nutrition for TB patients. And we realized that, probably less than 20% people gain optimal weight gain, so TB requires, it's a very direct correlation between nutrition and the outcome. So we felt that if we can improve the nutrition outcomes out here, perhaps the adherence and the treatment outcomes will also improve. Now, to do that, the first challenge we had was sort of convincing the not-for-profit to sort of take the underlying risk, to be paid on performance. And they said, well, we'll run a pilot. So that gave them the confidence. And when it came to the capital side, the commercial capital, so to speak, we said, look, to sort of do it, you may need some upfront capital. So we'll help you to get the risk capital. And their point was, look, I understand and assess that risk better. So instead of paying somebody whatever 8, 10, 12% return, I'm happy to put my own money on the table. So I think there is clearly a shift one is seeing where commercial capital can actually catalyze this. But I'd like to make one or two sort of related points out here. And as I said earlier, that, it's really about making something inefficient to efficient, because in a country with a $500 billion gap, you also need to use that capital wisely. So with that argument, and sort of looking at the larger context of mobilizing new pools, not only using what you have efficiently, my personal view is that that market, actually the best suited people to actually start shifting the needle there, and it's being done at the large, donors and people who can assess those risks and kind of lead this whole thing. So I really see that, why should it not become a part of every large donor, large foundation that, look, I'm going to put 10% or 5% of my money, which I'm giving as grants, as for pay for performance. And again, the idea is that it's really an R&D lab, because you again saying, look, I can improve the outcomes from X to 2X, 3X, whatever the needle is, right? So if you're doing it, you're actually using your own money to drive efficiency. And once you do it, then 90 or 95% money which you are actually giving to others, perhaps learnings will come out which will make you more efficient. So I think it's just not about the commercial capital, it's also of the usage of that capital which is available to sort of improve it. Now, to your point on, the social stock exchange, I think it's a very relevant sort of argument for India, for the simple reason that if you look at in our context, clearly a lot of wealth has got created in India in the last many years. And, we have a fairly robust stock exchange system in India. And from a social perspective, when you look at 3 million odd not-for-profits, there has to be some pecking order, like you have in on a sort of a capital market where you can say, okay, what are the top 100 performing companies or top 300 performing, whatever sector you pick. So I think the social stock exchange can do a couple of things. One is, if you start driving efficiency and output-based discussions and not-for-profits, it'll start making them think, okay, so how can I do this better? And that's a great way to learn. So clearly, I think the social stock exchange can play a role to sort of, start creating systems where these not-for-profits really start getting ranked, rated in some form. And I think that's a great outcome in itself, because, apart from just the larger donations, in India, retail philanthropy happens at a very large level. If you look at it, I think maybe $4-5 billion of money is given away. Perhaps 10% of that goes into structured social enterprises, more into, temples and other religious places. So how do you bring that money in? How do you sort of engage a retail person into this idea that I want to do good, but how do I participate? So I think social stock exchange not only can help to sort of create this efficiency around these not-for-profits, but they can also help us to unlock that money and kind of democratize retail philanthropy. And how do you do it? I mean, there are structures available. You have the alternate, AIF fund structures for social venture. It's not really taken off. So we need to look at it. What is needed more to be done to sort of, make these structures work? You also have things like done by, the HDFC Cancer Fund. Clearly, you can have structures there if you actually, so I think the point being that if I can price an outcome and say, okay, to cure a TB patient costs $200, to educate a child costs $500, to so on and so forth, and I could then say, what, I can actually fund 5 students, or I can actually, help to cure 5 TB patients, and so on and so forth. So I think if we can structure, streamline the pricing of outcomes, B, we can have larger financial institutions, intermediaries come out with these mutual funds or whatever, and give them a tax break and say, look, all your interest or whatever the structure is will go into funding this. I think the stock exchange and these markets can really help to sort of organize it. So I think clearly India has the tools, it has the intellect, it has the capacity to do it. I think it just needs everyone to come together. And to your point about cost, I think, look, in our structure, I can tell you the Mukti bond, which is around TB and nutrition, and a very close relationship with outcomes. A lot of funding support was given by USAID, and all credit to them. The government of Madhya Pradesh, I must credit them the way they came up and supported this whole thing. So I think the investment has been made. Now scale up, we need to have other stakeholders come in and say, look, you spend all that money, let us come in and let us help you take it from, 1,000 to 10,000 patients. So I think there's a role for commercial capital as well as social stock exchanges, and a lot can be done if all of us come together.
Absolutely. And I think on that point, I think when we're talking about scale up, I think it's absolutely important to hear, the government perspective. So we have Hardikar sir, who's here with us, as well as Meet from NSTC. I think both very important perspectives. So Hardikar sir, if I could maybe, bring you into the conversation. Firstly, thank you so much for joining us. I know it's late, and agreeing to come on this panel discussion as a special guest, both you and Avneet. But I don't think a conversation on pay for success and scaling that in India would be complete without really hearing from the government. Would love to hear your views, sir, on, why are you looking at impact bonds? From your perspective, what do you foresee as the biggest challenges in contracting, and how can these instruments really fit into your procurement guidelines that currently exist?
Yeah, thank you, Aparna. Thank you, everybody, for inviting me. Looking at the panel, which is really having so much experience on impact bond and such different and new ways of financing, that me speaking on this forum is really a privilege, and thank you again. We have been working with Asha Impact and your team to create first impact bond in government sector, at least in urban sector. And with my limited understanding, what we have realized is that it's a really an exciting field where government would love to be part of, because it's so far our experience of financing various development schemes and programs has been of financing for outputs rather than outcomes and impacts. So we would definitely love to be on this anywhere when a measurable impact is getting created in any field. It would be really in the interest of the government and the taxpayers, whose money is what really we are investing. So in this background, what we are having challenges today is that we lack an framework in which we would like to work in, because we are used to traditional norms, traditional tendering, and traditional procurement systems. And when we are asked to suddenly find out investment financer, risk funder, or a service provider who are willing to work with us, but we don't know, or the mechanism of discovering the risk costs is not transparently laid out. In the absence of that, we would be finding it little difficult to engage with this kind of investment tools. So we will have to work in a best earnest with various experienced stakeholders in this domain, like Ford Foundation or Dell Foundation or USAID, who have been already investing into this instruments in finding out better ways of standardizing these investments from the government side to achieve impact. What really I'm keen as a city administrator today is that we have been doing a lot of incubation centers and supporting a lot of startups with innovative ideas, conducting a lot of hackathons. So I really find this kind of an investment tool very interesting, because now I am sitting with a lot of inventory of hacks which have been awarded at various forums by government or corporations or smart city missions at various locations. But now we can really find a way through these impact bonds, through risk investors coming in from real capital markets, which can actually pay for impacts, and we can be safely be saying that an innovative technology which has not yet been tried and tested can actually be grounded not just remaining as an idea, because we have had many ideas come forward. We have been toying around with so many new concepts. We have been toying around with an idea of green bonds for SDGs and all those things. But to actually really see it happen on ground, getting grounded through an impact mechanism is really wonderful idea. We would be willing to work with various impact investors, various service providers, and learn from the experienced stakeholders who are already present and esteemed panelists here. We would like to collaborate, and I think urban infrastructure or social infrastructure, rural livelihoods, and urban poor and their housing requirements are the three sectors with, as I said, technology for future are the sectors in which a lot of investment financing can come in urban areas. Thank you.
Thank you for that, sir. I know we've had a few discussions in the past, so definitely, I think it's been great learning to hear from you as well. And as yourself and Avneet from NSDC will be talking about the government's perspective, we do hope that there are more administrators like you that are willing to work with people on the panel and others in the ecosystem to actually help scale up this instrument, because like you said, there's no better way. And Ellen mentioned this as well. We have to use the taxpayer money efficiently. We have to move the needle on social outcomes, and it has to be done collaboratively between the government, between investors, and civil society. So thank you for sharing your thoughts with us. Avneet, last but not the least, thank you for waiting very, very patiently, but we're very excited to hear from you as well. Since NSDC has been looking at a few instruments, of course, all in the skilling space, but a couple of different instruments, as you were mentioning. Would love to hear your thoughts. How are you looking at using pay for performance? Where does it kind of fit into the overall strategy for NSDC?
Right, sure. Thanks, Aparna. Thanks for inviting me, and really heartening to hear that at the state level there is such openness to receiving complicated structures that we are all struggling with as we speak as well. So very quickly, Aparna, so NSDC, as you might be aware, is a public-private partnership. So in this capacity, I would say we are rather well positioned to leverage both the industry and the government side, and thereby bridge the ideological gap that exists between the private impact investor and the public funder. So although traditionally the skills ecosystem was mostly dependent on government grants when it started over a decade ago, it has now matured and there is keenness from the private sector to participate. So NSDC is therefore exploiting this present situation by exploring various innovative outcome-based financing instruments, with the aim of both encouraging private sector funding and very rightly, as Mr. Ellen pointed, improving the quality of skills outcomes, because we are really not looking at funding here. We have huge grants and we have access to those. The space is not as well funded as education, but I don't think we are lacking funding. It is about improving quality, which is what Dalberg and SDF and all of us are struggling with as on this bond that we are working with the British Asian Trust on, along with MSDF. So this is also very interesting. It's called the Beyond COVID Skill India Impact Bond, and through this bond we aim to tackle various challenges in the wake of the pandemic. And also, given the gender focus of one of our outcome funders, that is SAFE, we are particularly keen to focus on improving skilling and employment outcomes for women. We are also considering other blended finance solutions such as skill loans. For example, as we were speaking earlier, we are engaging with Social Finance India for creating sustainable livelihoods by providing affordable skilling loans to low-income youth. And NSDC, as the anchor investor here, aims to build the market initially to crowd in other investors. And we believe that by using the grant budgets of philanthropic donors as the first loss guarantee can increase the scale and impact and build the market for affordable loans in the long term. And we hope to actively work with many such instruments and address various wicked problems that otherwise remain unaddressed. And I look forward to conversations with you after this as well to take this forward. So I'll stop there. Thanks.
Great. Thank you so much. And maybe if I can just, ask you one last thought, Avneet, is, of course, this is, the first time around NSDC is doing this. And of course, there are challenges and, Prachi and Tushar, and you all spoken about it, that how do you price the outcome, how do you price the risk. Is there certain data, information that you think would make it easier? And I'm asking more from, not maybe just from NSTC, but from the government perspective. How do we really encourage, adoption by other government or quasi-government bodies? So do you think certain amount of data information would make this easier, and what specifically would that be?
Right. So like everyone has pointed already that pricing the risk is the key here. And NSDC, since we implement large-scale government programs, therefore data collection has always been an integral part of our reporting and monitoring mechanisms. However, I would say that the data talks the language of the system, which at present focuses on inputs and not outcomes. A distinction that we've all realized is significant. So, for instance, there is this PMKVY program that we talk about, where 80% of the payments are linked to enrollment and certification, and only 20% of the payments are linked with placement, and retention is somewhere bundled in the scheme there. Therefore, mechanisms to track this important information are not robust, or they don't exist at all. However, the government and other stakeholders, like you rightly pointed, are interested in such data. So we believe that through instruments such as this, we will be able to price the risk, and which needs data, which will come through such instruments. And in doing so, it will be easier for governments and other such bodies to accept this and to participate.
Sure, absolutely. I think the first couple of such instruments will help create that evidence base as well. And hopefully then we can look to actually creating market-based instruments, picking up from these pilots. Thank you so much for sharing your thoughts and, for joining us as a guest today. I'm really happy to have you here with us. I know we were getting a couple of questions from the audience, and we were asking them as we went. So, on that note, I'll maybe hand it over to you, Neha. Thank you. A very, very big thank you to all the panelists and the audience. I know it's late, but thank you all for joining in and very candidly sharing your thoughts. I think look forward to working with everybody together on this, and as an industry, really finding ways to bring these instruments to market quickly and address these issues in a very outcome-targeted way. So thank you all. Over to you, Neha.
Okay. Thank you, Aparna, for such a smooth moderation. And a big thanks to all the panel members for such a positive conclusion. With this, ladies and gentlemen, we come to the end of the day 4 of Prabhav 20. We invite you to join us tomorrow, day 5, the final round of sessions our ISC team has lined up for you. We begin our day with a keynote by Mr. Omidyar, CEO GIN, to smashing roundtable discussion on healthcare and technology for good. We also bring to you a masterclass on Iris by Jin tomorrow. Thank you very much, everybody, for your participation. Take care. Goodbye.
Thank you.